Conflicts of interest has three standards: disclosure of conflicts, priority of transactions, and referral fees. 6A is disclosure of conflicts. The larger point here is that ideally in the investment management business, the best practice is to avoid any conflicts. However, that is often difficult to do, and the code and standards recognizes the fact that there will be several conflicts. If not actual conflicts, then there might be a perception of a conflict of interest. And this particular standard explains how to deal with those conflicts and specifically how to disclose those conflicts. Members and candidates must make full and fair disclosure of all matters that could reasonably be expected to impair their independence and objectivity or interfere with respective duties to their clients, prospective clients, and employer. Members and candidates must ensure that such disclosures are prominent, are delivered in plain language, and communicate the relevant information effectively. Let's look at the guidance, and the point is that conflicts can appear in several forms and in different aspects of your work as an investment manager. So let's look at the disclosure of conflicts to employers. We've talked about the fact that if you work at a particular company, and let's say this is an investment management company and this is you, are there potential conflicts over here? Obviously, the answer is yes. We talked earlier about a situation where a client wants to compensate you for the excellent work that you've done. Does that create a potential conflict of interest because you might then be biased towards this client at the expense of other clients in the company? The answer is yes. And clearly, this conflict needs to be documented. Another scenario might be that you are working at a charitable organization. So on the surface, your work for this charitable organization does not have any conflict with your work at the investment management company. However, you are passionate about this cause and spend a lot of time working over here, spend a lot of time thinking about this work, and that potentially creates a conflict because it takes away some of your energy that you should be giving to your client to this particular engagement. If you feel this is possibly the case, again, this conflict needs to be disclosed. Another simple scenario that we'll talk about here and then talk about again later is where you own certain stocks and you are also trading these stocks for your employer. That creates potential conflicts of interest that need to be disclosed. Moving to the next one, disclosure to clients. Some of the items here will be similar. If you are trading for your client and you own the same shares that you are asking your client to buy, clearly there is a potential conflict of interest. You might be asking the client to buy those shares so that the share price goes up and you personally benefit. Another situation might be that you receive compensation from your employer for recommending certain mutual funds to the client. Now, this conflict needs to be disclosed because when you are recommending the mutual fund to the client, obviously the client believes that you are making this recommendation with the client's best interest in mind. But if you get a 1% commission for making this recommendation, that commission needs to be disclosed. The client can then evaluate for himself whether the recommendation that is being made has anything to do with the 1% commission that you get. Another possible situation is where you are making buy recommendations to your clients for a given stock. Let's say you are making a buy recommendation for General Electric, and at the same time you or your organization has an investment banking relationship with that same company. This needs to be disclosed to your client because your client can then decide for himself whether this buy recommendation is in his best interest, or is it possibly being made because you, the investment advisor, would like to keep GE happy because of that other potential business that you have with GE. And this connects with the next item, which is cross-departmental conflicts. And we've talked about this in earlier standards also. A classic scenario is that you are a research analyst at a brokerage firm. So there is the research department, and then there is the investment banking department. The investment banking department might put pressure on you to write favorable reports for certain companies, specifically those companies with which the investment banking department either has a relationship or wants to build a relationship. Now, what do you disclose? We've talked about the fact earlier that if there are companies with whom your investment banking department has relationships, ideally those should be on a restricted list. But if that is not the case, let's say you work in a relatively small country where it would not be practical to do this, then the fact that your company has a relationship with these companies needs to be clearly disclosed when you are making investment recommendations. A big item that I've already alluded to before is conflicts with stock ownership. And this applies both in terms of disclosures to employers and disclosures to clients. If you own a particular stock and you are trading that same stock on behalf of your employer, and you are encouraging your clients to buy that stock, clearly there is a conflict of interest that needs to be disclosed. Conflicts as a director. This is where you are working in the investment management industry, and let's say you are also the director of a given firm. In other words, you are on the board. As a director, there are three possible conflicts that might show up. We can refer to these as conflicts, or these are areas that might make it seem like there is a conflict. Number one, there will be a conflict or a potential conflict between the duties owed to your clients and the duties owed to the shareholders of your company. In other words, as a director, you need to represent the shareholders. As an investment manager, you need to do what is best for your clients, and at times there might be a conflict. The second scenario is where you receive securities or options to purchase securities of the company as compensation. So you are on the board and you either get company shares or you get options. And this might raise questions because clearly you get rich if the stock price of the company goes up, and you are advising your clients. Let's say you advise your clients to buy the shares of the company where you are a director. That would be a conflict. And this also connects with the earlier item that we just talked about. The third scenario is where your service on the board or your position as a director potentially makes you privy to material non-public information. So if you are trading, there might be questions as to whether you are trading based on material non-public information. In terms of recommended procedures for compliance, you should disclose special compensation arrangements with the employer that might conflict with client interests, such as bonuses based on short-term performance criteria, commissions, investment fees, performance fees, and referral fees. In simple terms, any sort of compensation that you get where there is a potential for the appearance of a conflict of interest, that should be disclosed. If your firm does not permit such disclosure, you should document the request and may consider disassociating from the activity. I'll give you a simple example. Let's say that when you sell mutual funds to your clients, you get a 1% commission. And let's say that your firm does not allow you to disclose this commission. That would be a major problem. And in this case, you may consider, in fact, you should consider either asking your firm to fix this problem. If that doesn't happen, then you should disassociate from this activity. 6B, priority of transactions. Investment transactions for clients and employers must have priority over investment transactions in which a member or candidate is the beneficial owner. Make sure you understand this beneficial owner concept. When you execute a transaction where the transaction is happening for your own account, obviously you are the beneficial owner. But let's say that the transaction happens through your spouse's account or your children's account or your parents' account. Even though those accounts are not directly in your name, but you still benefit. So in a sense, you would be considered the beneficial owner there. The point is that this particular standard applies not just to your account, but to the account of anyone with whom you have a direct relationship. Coming now to the guidance, the first point has to do with avoiding potential conflicts of interest. As I mentioned earlier, the best practice is to avoid anything that creates a potential conflict of interest, but in the investment world, that might not always be possible. Conflicts of interest will exist, and in fact, there is nothing inherently wrong with someone in the investment profession making money on his trades. So if somebody buys into a stock when it is priced relatively low and sells later when the price is high and makes money, there is nothing inherently wrong as long as he follows 3 basic rules. Number 1 is that the client should not be disadvantaged by the trade. In other words, let's say you are the investment management professional, you execute a sell order, that trade